Hi, Nicole from Michigan, and I have a question on I bonds for 2023. At the beginning of 2022, it seemed pretty intuitive to just go ahead and do I bonds because the rates were so high. With those rates coming down and how long you're locked in for 5 years without losing some interest, would you still be investing in I bonds right now at 6.89% through April 30th, 2023? I'm also kind of playing into this CD rates being so high right now in the mid 4% ish range. Would you still be investing in I bonds or maybe considering putting some money in CDs because it's so high as part of like the more conservative part of your portfolio? What do you think?
Okay, well, you're absolutely asking the right questions. You're thinking the right way about I bonds and about CDs. These are the safe assets in your portfolio. CDs, bonds, money market funds, EE savings bonds, I savings bonds, tips. These are all the sort of things that are in the safe money portion of your portfolio. Now, obviously, nothing's 100% safe, but these are far safer assets than stocks or real estate. So you're thinking about them the right way. What you put that money in, let's be honest, doesn't matter all that much. You just need to come up with a plan, stick with it. For many of us, it's a pretty small part of our portfolio. Like in my case, it's only 20% total that goes into these safe assets. The rest is in risky assets, 60% in stocks and 20% in real estate. So I'm only messing with 20% of my portfolio here. So I try not to make it too complicated. I just split mine 50-50 down the middle. Half of it's indexed to inflation, the other half is not. And that's the approach we've taken. And that seems to work pretty well for us. On the inflation side, we've got tips, whether in a fund or bought directly at Treasury Direct. And we have I bonds, which we started buying, a couple of years ago. And obviously you can't get that many in your portfolio because each person can only buy $10,000 a year of them. So it's hard to, if you want to invest $1 million into them, you just can't. So we started doing that a couple of years ago. We've continued doing that. I did it this year in January, just like I did a backdoor Roth IRA. On the other side of the portfolio is nominal bonds. In our case, we've maxed out my TSP from my military service with the G fund. And the rest is basically a municipal bond fund. Now, a CD I would put on the nominal side. I bonds I would put on the inflation index side. But you can argue back and forth all the time of whether I bonds are better to buy right now or tips are better to buy right now. And then 3 months from now, the answer may be completely different. Clearly, with inflation coming down, the I bond rate is not going to be as good as it was last year. Last year was like the best investment out there. It was almost 10% with basically no risk of loss. Is it going to be that good this year? No. Is inflation still going to be above average? I think so. I think you can count on getting a decent return for another year or two from them. But even if it goes beyond there, remember what happens with I bonds. If inflation spikes its ugly head again 8 years from now and you still own these I bonds, that rate goes back up. And you've already got not just the 10,000 you can buy that year, you got all these ones you've been buying each year since, whose rate also goes up. So I think it's okay to invest in I bonds. I would not bounce around so much where you're trying to jump from one thing to another all the time. Just follow your long-term plan. If you like I bonds and their investment characteristics, then add those every year to your portfolio. If you don't, it's okay. They're not mandatory. Remember how they work, though. You can't sell them for a year after you buy them. And if you sell them between the end of the first year and the end of the fifth year, you lose 3 months of interest. So there is a little bit of a penalty to not holding on to them for 5 years. But even when you add that in, it might still make sense to sell them after 2 or 3 years. So if you're bouncing around really looking for the very best yields and you're like, okay, now CDs are a little bit better than what I'm getting in I bonds, I'm going to sell the I bond and get CDs. That's reasonable to do. I don't watch that closely. It just doesn't matter that much to me. And so I think it's fine what you're doing, but I'm continuing to just invest in I bonds every year with a relatively small portion of my portfolio. Hope that's helpful.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.